The purpose of an audit in accounting is to provide an independent examination and verification of a company's financial statements and related information. The audit process is conducted by external auditors, who are independent professionals hired by the company to express an opinion on the fairness and reliability of the financial statements. The primary objectives of an audit are to enhance the credibility of financial information and provide assurance to stakeholders. Here are key purposes of an audit in accounting. Financial statement verification. The primary focus of an audit is to verify the accuracy and completeness of a company's financial statements. This includes the balance sheet, income statement, and statement of cash flows. Fair presentation. The auditor assesses whether the financial statements present a true and fair view of the company's financial position and performance. This involves evaluating the application of accounting principles and the disclosure of significant accounting policies. Reliability of financial information. The audit aims to provide assurance to stakeholders, such as investors, creditors, and regulators, that the financial information presented by the company is reliable. This is crucial for making informed decisions about the company's financial health. Compliance with accounting standards. The auditor verifies whether the company's financial statements comply with relevant accounting standards and regulations. Compliance ensures consistency and comparability in financial reporting across different entities. Detection of errors and fraud. Auditors are responsible for identifying material misstatements in the financial statements, whether due to errors or fraudulent activities. Detecting fraud is a critical aspect of an audit, and auditors are trained to assess the risk of fraud and implement procedures to uncover potential fraudulent activities. Internal control evaluation. Auditors assess the effectiveness of the company's internal controls over financial reporting. Strong internal controls help prevent and detect errors and fraud, and auditors provide recommendations for improvement if weaknesses are identified. Audit opinion. At the conclusion of the audit, the external auditors issue an audit opinion expressing their professional judgment on whether the financial statements are presented fairly and in accordance with applicable accounting standards. The opinion is a key factor influencing the confidence of stakeholders in the company's financial reporting. Stakeholder confidence and trust. The audit process contributes to building confidence and trust among stakeholders, including investors, lenders, and the public. Knowing that an independent, objective examination has been conducted enhances the credibility of the financial information. Regulatory compliance. In many jurisdictions, companies are required by law to undergo an annual audit. Compliance with auditing requirements helps companies fulfill legal obligations and regulatory standards. Risk management. The audit process involves an assessment of financial and operational risks. This helps companies and auditors identify areas where there may be a higher risk of material misstatements and allows for the development of strategies to mitigate those risks. While audits provide valuable assurance, it's important to note that an audit does not guarantee the absence of errors or fraud. Auditors provide a reasonable level of assurance based on their examination, and stakeholders should be aware of the limitations inherent in the audit process. Additionally, companies may also conduct internal audits as part of their internal control and risk management processes.